QuickBooks Pro Plus Desktop 2022 OneNote presentation, bank reconciliation reports for month number 1. Let's get into it. Within 2, it's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introductions, 9120 bank reconciliation reports, month number 1. Also, take a look at the Immersive Reader Tool topic introductions. They're in the text area too with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Same name and number as presentations as well. The topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're looking at the reports that are going to be generated after completing the bank reconciliation, which we were on the verge of doing last time, but then didn't click that button quite yet. We're tying out what is on our books as of the cutoff date, January 31st, the bank statement date, to what is on the bank statement. There's going to be a difference, that being the reconciling items. We went to the banking dropdown, we went to the bank reconciliation, and then we're going to open up the bank reconciliation. The beginning balance is now correct, and the ending balance is correct. We checked everything off, which looks good, and now we have the 0 down here representing the fact that we are ready to reconcile. This, by the way, is not a reconciliation report. This is the process of bank reconciling, and the items that are not checked are the reconciling items, those being the outstanding checks and deposits, which will be used to generate the report when we click this little button. Remember that you do not want to click the little button typically if you're off by anything here, even if it's just $1 or a few dollars. You might say, well, that's pretty close. I'm like pretty close, but notice that you should be able to get it like exactly, because you're just taking and tying off what is exactly on the bank statement to the books. And any variant, even if it's like a few dollars of variant, means that that change could have been from multiple checks and multiple deposits that are netting each other out to result in a fairly small difference. So what you want to do is try to get this down to 0, because that means that it's very unlikely that you're going to have checks and deposits that net themselves out exactly to reconcile exactly out. So, and that's why it gives you that more assurance, not just that the ending balance is correct, but that all the transactions have been input. That gives you sure verification not only for the cash account, but also because of all the transactions in the double entry accounting system for all the other accounts that are being involved as well. So if that gets to 0, if you don't get to 0 and you hit reconcile, it'll enter a journal entry, which will force it to reconcile, so you can do that, but it lowers the number, the amount of security you have, the internal control, the point of doing the bank reconciliation a lot, even if it's only off by a little bit. Okay, so if we click that button, we got the bank reconciliation. Now there's 2 reports. There's the summary report, and then there's the detailed report. The summary report is easier to look at, but you really want the detailed report because that's going to give you the detail of the information that you need. Notice there's a lot of junk in this report that you don't really need, but they add it here. The heart of the bank reconciliation is right down here. This is the heart of it. The stuff up top is mirroring what has cleared. So you've got the beginning balance, which is going to mirror what's on the bank statement, and then you got the checks and the deposits, which are going to mirror what's on the bank statement, and the cleared items. And that's going to be the cleared transactions. And then what you're really looking for are the uncleared transactions, outstanding checks and deposits, which are going to be the reconciling items to the register. So that's why this is the heart. If you give this to an auditor, this is what they're looking for. Now, if you go to the bottom half, it gets to you the new transactions after the bank reconciliation date, which again, I don't see why they even include that. It's not really it's not really, relevant to the bank reconciliation as of 1/31. So this is what we're looking for here. However, notice how they group the checks and payments together. That, if I was an auditor, doesn't give me a lot of help in terms of what the reconciling items are. I want to know what the checks were, who they were written to, did they clear in the following period. So although this report's a nice one to look at, it doesn't really give you the information you want. And so then if we expand it to the detailed report, then you got all this stuff up top, which once again is mirroring what happened on the clear transactions on the bank statement, which isn't really what you're looking for. You're looking for the unclear transactions. So I copied the heart here. So here's the heart, the unclear transactions. That's what you want. So now I've got the detail of those 6 items that were reported up here just as a lump sum. And I've got the detail of that one item that's reported for the deposit. So now I can verify that these are legitimate outstanding checks and deposits by seeing if they cleared the bank in the following period or some period after January in this case. And if they did, great. That doesn't mean they're not outstanding anymore as of January 31st. It means that they are outstanding as of the cutoff. Those are the timing differences between our books and the bank. They're legitimate transactions that are properly put into our book, and they exactly reconcile our books to what's on the bank statement. Here's on the bank statement. This is what's on our books that's going to be on our register. And so it tells us exactly what that difference is. And the fact that it tells us exactly what that difference is doesn't mean that we're just verifying these items. We're not just trying to check that these items cleared, although we want to do that to give us more assurance that this is a proper bank reconciliation. But by having that exact difference mapped out, that gives us further verification that all the other transactions have been entered properly, because we had 2 sets of books that did it, us versus the bank. They agree with each other, giving us an external verification, not only checking the checking account then, but every other side of the transaction that's involved, which is going to be including the construction of much of the rest of the financial statements, the balance sheet and the income statement, like expenses, of course, and revenue and so on, that will be involved. It's not the only internal control, but it's a huge internal control because cash is the lifeblood of the company. It's involved in every cycle. So if we can verify the transactions, not just the ending balance, that have taken place, and verify that each of the transactions that are increasing and decreasing the checking account are real, then the other sides should be going somewhere with the double entry accounting system to revenue and expenses, for example, or to, accrual kind of components. But those should be real, and that's where the verification is. So this report is important. And also notice it's not a report that's generated from us entering data into the system. Unlike every other report, it's a verification report, an internal control report. So you probably want to print this one out as you make it, because if something gets messed up, it's not easy to get back into the same report, meaning QuickBooks can't really keep this report up to date as you enter more data into the future, because someone could enter something into the past, possibly deleting some of these checks, which would throw off the bank reconciliation. So you want to have this printed out so you can see what the items were that were uncleared at the point in time that you did it. And if someone deletes something that happened in the past, then you want to be able to get this report out and check it. QuickBooks can't update the report all the time that way, because normally if you deleted something in the past, it would then change this report. And if it changes this report, it wouldn't work because you would no longer be reconciled at that point in time. So it's a little bit different in nature. So here's our balance sheet number, the 88645, and then there's the 88645. So we're reconciling bank statement to the balance sheet number. Now, if you were to do this, like just to think about this in theory, notice what the bank reconciliation did. When we opened the bank reconciliation, it just basically took our general ledger accounts that we took in place, and then we had our beginning balances, and then we ticked and tied off all the stuff that cleared in our general ledger, in essence, is what we did. And then the uncleared items you could think about basically from the general ledger account are reconciling items. So this item on the left is basically us constructing what QuickBooks does, the bank reconciling process, not the bank reconciliation. If you think about this from a book standpoint, a book problem, I mean, usually you have 2 columns, a book balance and a bank balance. And you look at the differences between the two. So this one was a withdrawal, which wasn't on our books, but was on the bank statement. So we're kind of wrong. So we put that here. Service charges were on the bank statement, but on our books. So we were wrong. So we had to adjust our balance. And then you'll have the bank balance, which started here. And then we had the adjustments were the stuff that was on our books that wasn't on the bank. And that's going to be these ones that we didn't check off from the GL here. And so if we add those up, then we get to an ending balance for the book and the bank that tie out. Now, the thing that's different between a book problem and QuickBooks is that once we find out what these items are, we're just going to enter them into the system. So what we did in our system, we didn't actually do this side. We just said, hey, if it's on the bank statement and it's not in our books, we're just going to fix it. So then we went in and we just fixed these by doing the journal entry to add them to our books, because the bank statement's not wrong. It's just that we didn't know it. We had to add that to our system. So once we do that, then our ending balance will be this ending balance, and we won't have this book balance side that we need to adjust because we will have adjusted it, and then the bank reconciliation will just be this side of the bank reconciliation that you might have seen in like a book type of problem. So it's kind of useful to do a book problem and kind of think about this from like an Excel standpoint. We have some courses on that if you want to look at that.